Welcome to The Ride. Life, Work, and Wealth podcast with your host, Kris Dureau. Years ago, Kris was a firefighter and a paramedic and witnessed many people not getting another tomorrow, and it shaped who he is now as a financial strategist. Kris doesn't just help people plan for a secure tomorrow, he helps them plan for a better today. Kris lives in Burlington, Ontario, and is an investment advisor at Three Hats Financial, a trade name of Harborfront Wealth Management, and IROC dealer. Let's get to it.
Welcome back to The Ride, Life, Work, and Wealth. Host Kris Dureau of Three Hats Financial continues his tax discussion with guest Peter Simpson of Simpson and Associates, a full-service accounting firm. Peter has more than 20 years of experience in tax and management accountings. This is part 2 of his talk with Kris.
Thanks, Patrice, and thanks, Peter, for returning to the show. If listeners recall, we had Peter here a few weeks ago talking about tax tips for individual. So today we're going to do the second part where we're going to be talking about tax tips for small business owners. Since it's now a new year and it's never too early to start thinking about tax planning strategies and how to bring down your tax bill, especially now while you still have time to make some positive changes to your tax situation, since we're obviously well ahead of the tax filing deadline. We'll have a chat about a few areas that we get common questions to. So Peter, once again, thanks for coming. And let's start with just simple things like collecting receipts for business related activities that can be done by if you're a sole proprietor or a corporation. And I know that my wife, Tina, who does my bookkeeping, absolutely hates this part because I just jam all the receipts into my wallet and she gives me crap every month when I have to pull them out and they're all crumpled in little balls. So let's go over some ideas on the importance of this. And Peter, if you can give us some tip on like collecting them, making sure they're organized, what we should be keeping track of. And as an accountant, when you get all these receipts, what would make your life a bit easier and things like that.
Sure, no problem, Kris. Thanks for having me back. So large corporation, if you're self-employed, you're just on your own. It's very important to keep track of your receipts, either in a original form or as a PDF. CRA accepts digital copies of receipts as well as the original receipts, as long as it's in some form that it's a fairly common digital retrieval situation, and the actual receipt is readable. So it's a great way of sort of getting rid of all your paper as well. Just make sure you do have a proper backup for them. So as far as receipts go, you do actually have to have a receipt. You can't use a credit card statement showing the amount on it, because CRA wouldn't know if you're at a gas receipt and you went in and bought all your Christmas presents at the local Esso, or you actually bought gas. So you have to show what it was that you purchased. As far as categorizing them, the common categories for, say, a self-employed person might be telephone and advertising and promotion, meals, any types of typical expenses. I like to see them categorized as an expense category, not as in date order, because if they're in date order, I still have to take them and then rejig them into categories. So putting them in a category list would be great. I do have clients that say, here's a big box of receipts and you guys sort it out, and that's perfectly fine as well if they don't mind paying for some bookkeeping time to do that. It could even be more efficient because everybody's good at something and some people just aren't good at organizing their receipts. So
And how long should these receipts be kept for?
Yeah, it's 6 years, because that's as far back as the CRA can go. But the CRA technically can go back further if they kind of see that you're, malicious intent. So they can go back many years. They can go back 10 years if they wanted to. But typically, it's 6 years would be the furthest back. And I don't typically see audits. I've been doing this for over 20 years, and I don't see audits going back that far. But you should technically keep them for 6 years.
And now, what about the dreaded mileage log for automobiles? Because
Yeah,
most
that's a tough
small
one.
business owners know exactly what I'm talking about with that, because I'd have to say majority that I know aren't the best at tracking that, because
Hmm.
it's not
Hmm.
the easiest. I know now there's apps out there like
Hmm.
Mile IQ is one
Hmm.
that it can kind of help you with this. But what have you seen over the years in regards to CRA and how strict they've been with that? Are they getting worse with it?
They're actually getting a little better. They're
Perfect.
they're being a little more reasonable and sort of real life about how that is dealt with most people. It used to be you'd have to show a mileage log. Back in the day, you'd have to have it all written out, and you'd have it in your paper diary, and you'd have to show copies of all of that to a CRA auditor. But now they still expect you to have some sort of tracking device of some kind, but they do accept, sometimes they'll even accept, say, 3 months out of 12. And if you can explain, where you went, and sort of more real life versus sticking to, exactly this and exactly that. So you should still track it. I mean, at the end of the day, you got to kind of track where you were at the beginning of the year on your odometer and where you were at the end of the year on your odometer. Gives you the total kilometers. If you have to go back over, a few months just to see where you traveled to and things like that, we could put something together. As long as you're reasonable about your automobile as well. I've got clients that I traveled 100% for business. And how did you do that? It's like you couldn't have. It's impossible. But keeping it reasonable, 70%, 60 to 70% based on your activity levels. I typically look at a client's tax return, and they give me their mileage, and I see that they only earned $10,000 and it was a part-time business, but they're trying to claim 85% of their car. I'll say, that's not going to fly. Um,
Yeah.
doing tax returns for this many years, you almost have a gut feel for, like, where you really should be at, and most clients are pretty good about that.
Yeah, you hear all the stories of pretty ridiculous things that people try to
Mhm.
write off, and some of the
Mhm.
horror stories of being audited, I guess.
Well, yeah. Yeah, and I do typically, I kind of explain it in a circular way. There's definite expenses. There's some expenses that might be a little bit challenging, and then there's the expenses that you don't even bother trying to go for. And
Yeah.
because the probability of audit just increases exponentially as you're starting to claim more and more. If you claim more than 90% for your automobile, there's a really good chance you'll be looked at.
Yeah, and especially after the year that would just passed, I don't imagine you'll have as many people claiming a whole bunch of
Oh
mileage for
yeah,
2020, because
no, it's so true. Yeah,
I
I got a
know
few
even,
clients that are way down.
yeah, that would be me.
Yep,
I know quite, and even some of my clients that just next to no driving. So that's
yep,
going to be a
yep,
big difference.
yep, absolutely.
Okay, so let's get on to now with the current environment, taking advantage of business
Mhm.
use of home expenses. So
Yep,
there's obviously much more people running their businesses out of their homes than there was even a year ago because of
yep.
COVID. So, what are some tax advantages of people now working in their home?
Yeah, Chris, the typical expenses that self-employed people can claim are things like their utilities they pay. If you have a cleaning, people come in and clean your home, house insurance, property taxes, mortgage interest. It's a really great deduction for self-employed people, as well as for corporations when you have a small corporation, because you're taking after tax things that you usually would pay for, and you're turning them into a before tax expense. So it's a really great deduction. So it's just key part of that is to not be aggressive about the square footage that you're claiming. Again, I always preach, just be reasonable about your expenses. Don't go crazy on them. You're already getting a nice deduction for things, so don't go way overboard. And CRA will typically leave you alone. I do 600 or 700 tax returns a year, and I've been doing them for over 20 years, and I don't see a lot of audits. I always try to tell my clients, just be reasonable about your expenses. Don't be nutty. Don't claim 90% of your home as an office, because those things just won't work. So those are the typical types of expenses. Again, you do have to keep the receipts for them. It's important that you have them if CRA does ask for them.
Any off the wall examples of anything over the
Oh,
years that you can think
oh,
of someone trying to
well,
claim them?
I've got clients who trying to claim their entire kitchen renovation, of $80,000, and they'll just try to deduct it as an expense, or just things like that, or claiming again like 80 to 90% of their home. If they got a 2,500 square foot home, and they're somehow saying that they've claimed 2,000 square feet for a two-person office. And it's just things like that just don't work. And those are the ones that typically would get audited. The CRA won't go after you for claiming 20% versus 18%. Or there's no money in it for them to go after a small differential, but there's good money there to go, wait a minute, you can only claim 20% versus 90%. So that's thousands of dollars.
Yeah. Okay.
Mm-hmm.
Now, we touched on this before, but with the personal side of tax tips, but let's just touch on this once again. RSPs
Mm-hmm.
RSPs and tax-free savings account contributions for business owners.
Mm-hmm.
So when should a small business owner think about putting money into their RSP?
It would be pretty similar situation. Well, when we're talking about business owners, we have to keep in mind there's corporations. So a small business owner has a corporation, and then there's self-employed individuals. So self-employed individuals are sort of like employees that have an employment income, because every dollar they earn gets taxed. So you'd sort of treat a small business self-employed person, and once you're up over somewhere in the $50,000 to $60,000 range is when you start to look at RSPs. Anything below $45,000, you don't get a great savings. You get between 15 and 20%. You might save, but anything up above into the 50, 60, 70, $80,000 range, you're starting to get into the 30, 40, 50% tax savings. Self-employed individual that earns over 200,000, they're getting taxed at 50% plus. So it's huge savings there for RRSPs. TFSAs are a great investment tool. As you know, you could probably talk about that more than I can, but you're saving money there because everything you earn isn't being taxed at all, any kind of investments. So as far as corporations go, I'll talk about this a bit later, perhaps, about when to incorporate and things like that. So I'll leave that one for now.
Yeah, because even then, that's also like with some of my clients, of course, they're getting their income from the corporation and they're over that and they can do RSP contributions, but then they also have stagnant money sitting inside their corporation, and the rules still allow us today, which is good, to still that they can still invest that money inside their corp.
Yep, up to a certain point, and then once you get above a certain level of investment income, it starts to drag down your small business tax rate. But you've got to be up to quite a bit of investment income for that to start happening.
Yeah, I feel that that's a kind of a low-hanging fruit for the CRA to eventually come back and challenge more, because it was a couple of years ago they were kind of trying to go after that, correct?
Yep.
Yeah.
Yep, they were.
So still an opportunity to do that as of now, but
we
just never know when that may disappear because there was attention on it before from CRA.
Exactly.
So, okay, let's get into that question, because this is one that comes up pretty common with a lot of small business owners, is when they should incorporate their business. It comes up a lot because owners think that, well, I'm being told I should incorporate, but as you know, Peter, there's extra costs and time to that. So when is it worth it for someone to finally take that leap and now incorporate their business?
Okay. This could be a 2-hour answer, or it could be a 5-minute answer. So I'll give you the 5-minute answer. How's that?
Sure. Yeah.
Or even less. So the general concept of a corporation is that it's a separate entity from the individual. So you've got this corporation over here, and you've got the individual here. The individual owns the shares of the corporation. So as opposed to being self-employed, the money flows through the corporation. Simple example, let's say you have $300,000 in revenue, $50,000 of costs, and you end up with $250,000. If you're self-employed, you pay taxes on that entire $250,000. If you don't need all the $250,000, let's say you only needed 150 of it, there's $100,000 sitting there that gets taxed at a really high rate, say 40 to 50% tax rate. So, and if you're in a corporation, you only need the 150, you take the 150 out and you pay taxes on the 150, 100 sits in the company and gets taxed at a really low rate. So the general concept is if you don't need all of the money you're earning, then you should be looking at incorporating. If you need all the money that you earn, all you're really doing is creating a corporation, have the money go into there and you take it all back out and you get taxed on it anyways. So there's no real point in having a corporation if you need all the money. And that, on top of that, if you're say at about $50,000 of income, it's not worth incorporating because you probably need all the money anyways, and your tax savings are very, very minimal. And it's going to cost you $1,500 to incorporate. It's going to cost you $1,200 to $1,500 to file a corporate tax return, and your savings basically evaporate. So there's really no real advantage to incorporating. So I would suggest, first off, you look and say, do I need all the money I'm earning? If the answer is no, then you go to the next point and saying, okay, that's the first level. It looks like I might want to incorporate. And then second level would be to go to an accountant and say, okay, I'm looking at incorporating. Here's how much money I only need. Here's how much money I'm typically earning. Show me how it might be worth my while to incorporate. And I typically, what I would do is run some scenarios for a client and say, and kind of show it on a spreadsheet very simply. Over 10 years, it's really worth, here's how much you will potentially save in incorporating. It's a convoluted answer, but does that help?
Yeah, no, it does. It just, especially with the number values saying of if how much they make, and if you're spending every dollar, then don't set up the corporation because of the cost, and not only just the cost. There's also a significant amount of time need to be dedicated to that to keep that in order. But a lot of people get confused when that line in the sand has been crossed and they should incorporate.
Yeah, I would say somewhere in the I wouldn't use net income as an example. I would use the money you don't need as an example. If you get to the point where you don't need, say, in excess of about $50,000 of your income on a consistent basis, then there's a really good chance that it might be worth the savings to you. To incorporate.
The other thing too, that we'll just mention is that, of course, aside from that, there's the advantage of incorporating because of the limited liability. So when a business is obviously incorporated, it's considered a separate entity from the owner. And then what that does is it just allows your small business to be on the hook and protect your personal assets from creditors and lawsuits. So if you have a small business that involves a great deal of risk, that's another benefit of having a corporation.
Yeah, one of the other benefits too is the capital gains exemption on the sale of your company.
Yeah, that's a big one.
Sale of shares of your company. So you incorporate, you build up this wealth in your company. The company is doing really, really well, and it's worth $1 million. And you go and sell the business. As long as it's considered a Canadian-controlled private corporation, and you would save 800,000 of that would be exempt from any kind of capital gains, as long as it was the sale of the shares of the business.
Yeah,
and that's not a simple thing to do. That would be more of a, you might want to, I'm not sure if you had a business valuator on or not before, but or a sales and acquisitions type person before.
Actually, we did from Grant and Thornton. We just did Ryan. We had him on there a few weeks ago for just for small business owners, how to prep to start getting their businesses ready to sell.
Right. And it's tough to sell a business these days. It's not an easy thing. And selling the shares of your business is a challenge sometimes for businesses, because the person that's buying them is buying the assets and the liabilities, or any potential liabilities of a business. So people kind of stay away from that a little bit more than buying the assets of your business, or a customer list, or whatever it is you might be buying.
Okay.
But there's definite advantage there, though.
Yeah. Okay. And then now, it may sound simple, but having a plan to pay your taxes as a business owner, because
Right.
I just know of some situations I've dealt with in the past with clients and things like that, where they have delayed doing this or didn't plan on the bill that they would be getting at the end of their calendar year in regards to what they would have to pay for tax. So, Peter, do you have some tips on how business owners should be organized and having a plan to pay their taxes?
Yeah, well, there's a couple things there, Kris. There's often I'll find the first time through a tax return with a self-employed individual, they are often surprised and shocked at how much tax they owe, because they're often used to being an employee, and they have their taxes taken off their paycheck, and everything typically works out, and there's hardly anything owing at the end of the year, or they get a small refund. And then they come along and do this whole self-employed thing, and then they owe suddenly $10,000 or $15,000 in taxes, and they kind of spent that money already. So it's
Yeah.
what I often do with new clients is I will run a tax return for them and say, here's what you're looking at earning potentially as income. Let's say you've got roughly this much in expenses, and here's your net income. This is for a self-employed person. And then here's what you'll typically owe. And I try to recommend that they put aside, into a separate bank account. It may seem silly, but open a separate bank account and put X percent every time you get paid something into that separate bank account. And it's the first year, because CRA doesn't ask for money ahead of time from people until they realize after a couple of tax returns that they always owe a bunch of money. Then they'll force you almost to make installment payments to them.
Mhm.
So in the meantime, I would just suggest going to somebody early and say, how much money will I potentially owe? And then you just put that money aside on a monthly basis or weekly basis even. It's way easier to bite off than having to owe huge amounts at the end. I've got some clients that they owe $20,000-$30,000, and the other side of it is, in addition to that, people that sometimes have ups and downs in their income, great ups and downs.
Yeah.
Like, for example, this year I've got a bunch of real estate clients that have done extremely well, and they've gone from $150,000 a year to $300,000 a year in commissions, and that extra 150, I'm hoping that they're saving some money aside for it, because it's going to cost them $40,000 in taxes. So it's good to go to your accountant just for a brief conversation. Here's where I'm at. Here's how much I might earn. Here's my typical expenses. Can you give me just a rough idea what I might owe in the spring?
Yeah. So I imagine it's good for, especially like you said, jobs like that where they fluctuate quite a bit,
Yep.
to do it at the beginning of the year, like now,
Yep.
and even like just doing a check-in or getting a tax projection from their accountant
Yep.
6 months halfway through the year, just so they can make sure that they don't have a big surprise at the end of the year.
Yeah, I mean, it's not too late even now, right? Here I am at the end of the year, pretty much. I don't expect to earn a ton more money, and you don't owe the taxes until April 30th.
Yeah.
So you still have 4 months. At least you're 4 months ahead of the game to sort of say, here's how much I'm going to have to put aside. And it's going to have to be a little more aggressive as far as the savings, but at least you've got something put aside.
Well, thanks, Peter. I appreciate that. And as we're getting close to, running out of time here, is there anything else you want to add?
Yeah, Kris, I was just thinking that we didn't really chat about HST, applying for an HST
That's
number
right.
for a small business. Typically, well, the rule is that you have to apply for an HST number if you have earnings of more than $30,000. But getting an HST number earlier, if you think that you're going to be running this business for a longer period of time, it's well worth getting an HST number, because you actually save money by claiming the HST on your expenses and charging the HST to your clients. So you actually would save money by having an HST number, because you don't have to pay HST. You get all the HST back on your business expenditures. So it's just something that it's worthwhile doing for small businesses. It's one more form you have to file, but I typically file it when I'm filing the client's personal tax return at the same time. So it's no huge added burden really, and it's actually saving you money.
Okay, great. Well, no, great point to throw in there at the end. Yeah, that's right. We did forget to talk about that. But thanks very much, Peter, for coming on again and giving my listeners some pretty good tips. And what we'll do is we will have you back as we get closer to tax time, because I know that's when a lot of people have more questions. Of course, I also realize that is the busiest time of the year for you, but we'll have you back on somewhere toward, maybe we'll tape it like 1 in the morning or 2 in the morning or something when you're free.
Exactly. Yeah, perfect. I'd be happy to come back. Thank you for having me.
Okay, thanks.
Okay, Kris, have a great day.
Thank you, Peter Simpson of Simpson Associates, and of course our host, Kris Dureau of Three Hats Financial. To make sure you know when new episodes of Kris's podcast are available, subscribe to The Ride, Life, Work, and Wealth using the subscribe button on this page. You can also share with the share button.
Thank you for listening to the Ride, Life, Work, and Wealth podcast. Click the subscribe button below to be notified when new episodes become available. All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harborfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.